Welcome to stage 2, level 2, where we'll be discussing yet another important topic or course called corporate finance. In this course, there are 6 major topics that we're going to look at. There's time value of money. We're also going to look at the valuation models for financial securities, which will include bond and stock valuation. We also look at what is called risk and return, capital budgeting, and dividend policy. So in the first 5 minutes, I'll just theoretically explain the introduction to corporate finance. So basically here, it introduces you to the role that a financial manager has. You will be entitled to be called financial managers in this course. So there are 3 main roles or 3 main financial decisions that financial or corporate managers make. They're what are called investment decisions. So these are decisions that are mainly to do with deciding on what investments to make on behalf of the company. So this decision-making process is what we're later on going to look in detail, which will be called capital appraisal. So a corporate manager must be able to make decisions for investment. These decisions must be for the benefit of the organization in evaluating which decision is appropriate and which decision is best at a particular state of nature. You're also, as a corporate manager, supposed to understand what are called financing decisions. Now, in financial decisions, we're talking about decisions that are regarding how we're going to finance our projects. So the decision to use a specific source of finance will be determined by the period of investment, whether it's a short-term, long-term, or a medium-term investment. So as a financial manager, you need to understand financing decisions. So you need to understand what kind of capital you're going to use, the capital structure, which may emanate from the plowed back investment or returns. These could be the profits in an organization. You also need to decide whether you're going to use debt finance, which comes through loans or debentures. You're also going to make decisions as to whether we're going to use share capital, which will come from the 2 types of shares, which are ordinary and preference shareholders. So you need to understand the financing decisions of the company. And finally, what we call the dividend decisions. These are decisions which ultimately involve determining what dividend policy a firm can adopt and how the returns for the shareholders will be distributed. Now, this policy describes when and how much profits will be distributed as dividends between the shareholders. Regarding the dividend decisions, you need to understand that in a company, we have the owners of the businesses who are the shareholders and the managers of the businesses who are the directors, the managers themselves. So there's an antagonism between how much must be shared between the owners of the businesses who are the shareholders and how much must be plowed back, because we know that the retained earnings are the cheapest source of finance for an institution because they don't accrue any interest on top. And this is why the shareholders and the managers of a business are usually in antagonism. So these are key topics on their own. We'll look at them later on as subtopics. So the first introductory part gives you an outline of how this course will be undertaken. Then from our financial accounting, you also need to discuss the different forms of organizations and their advantages and their limitations. We have a sole proprietorship, which is a one-man business. Going into a business as a sole trader, we know the advantages and disadvantages. It's easy to set up, it's very cheap, and this owner of the business will enjoy all the profits. There are small amounts of taxes paid, very easy to establish, and also decisions are made by the owner of the business promptly. You don't need to consult whomsoever. The disadvantages or limitations for such a kind of a business is that it is very difficult to source large sums of capital or finance because banks will be limited to how much collateral you may have. And the other disadvantage is that there's no limited liability. So we say it has unlimited liability, meaning the debt that a business may have may go beyond to personal assets. So if the business is owing, the creditor may come to go to as far as how much the individual as a proprietor owns. And also the life of this proprietorship is limited to the life of the individual. Once they die, the business dies as well. We also have partnerships. These are two or more associates who form a business, a corporate entity, which is determined by what is called a partnership deed. This establishment has unlimited liability, and the life of this partnership is also limited to the life of the partners in themselves. So if one partner dies, the partnership is dissolved. If one partner decides to join, the partnership is dissolved and started anew. And so there is some difficulty in transferring ownership. There is also difficulty in raising large sums of amounts because they're also limited. Of course, the advantages could be that there's a larger pool of skill and larger pool of resources. And finally, we have corporations or limited companies. These ones have unlimited life and unlimited continuity. There is a transfer of ownership in terms of shares, and this kind of establishment has limited liability, meaning the shareholders are only limited to how much they have invested in the company. When a company is indebted, it undergoes what is called liquidation. And this liquidation process only touches the assets that the individual investors have in forms of shares. So there are three factors that allow this corporation to access large sums of money. The trust that these ones have, limited liability, the firm's independent growth, and also the value of an asset depends on its liquidity. So we also going to look at key terms in this course, what are called primary and secondary markets. They also what are called capital and money markets. So you'll be asked to define what are primary markets. Primary markets are simply market structures where newly issued securities such as bonds and shares are bought. There is usually what is called an IPO, which is an initial public offer, which is usually done in the primary market where shares or securities are sold for the first time. Firms here will raise their capital usually through what are called the primary markets. We also have secondary markets. These are markets in which already existing securities are bought and sold. Here, the company that first issued the security does not participate in the secondary market. We also have the capital and the money markets. A capital market is simply markets for long-term debt and stock securities. In Zambia, we have the Lusaka Stock Exchange. In New York, we have the New York Stock Exchange. So in short, we trade long-term debt securities in the capital market. But if the securities are sellable within a year, short term, we call them the money market. Greatest example we can give are the treasury bills. So this is what we can say about the markets. So we also have what we call the spot markets and the futures market. So spot markets usually refer to buying and selling of assets on the spot at spot prices, while futures market refers to the markets where assets are bought and sought for a delivery at some future date. So you buy assets at a future date to negate issues of inflation and exchange rates. So these are futures markets where you're going to buy something in advance at the current price, regardless of the fluctuations in the market. So basically, that is much on the introduction. Today's class will essentially be on time value of money. Now, time value of money is one of the key topics in corporate finance upon which all other topics will hinge. They say time is money. And so I'm going to go through a few concepts that you must understand before I go into the calculations. Number one, you need to understand the concept of simple interest. Simple interest. What is simple interest? Simple interest is simply when interest is not reinvested. So the interest is only earned on the principal amount, and the principal amount is the amount we started with first. So if we started with 100 kwacha, 10% simple interest of 100 kwacha is 10. So if we calculate this by 10%, meaning you're going to be getting 10 kwacha continuously. So this is what we call simple interest based on the original figure. So we also have what is called compound interest. So for simple interest, our figure will increase with the constant amount, 110, 120, and so on and so forth. But for compound interest, the interest is earned on interest earned over time on the accumulated figure. So if we started with 110, 10% of this will take us to 110 because of the 10 kwacha we've added. Now 10% will not be on the original amount, which is called the principal. It will be on the second figure here. So 10% of this will be 11. So here we're going to have 121. So you see that compound interest is based on the previous amount as a percentage. So we also have terms that we're going to use.
Sorry, Mr. Collins, could you go over compound interest again? I didn't quite get.
All right. So although I'm going to look at the formulas later on, I was saying if you have 100 kwacha, simple interest for month 1, month 2, and month 3. So 10% of 100 kwacha is 10 kwacha. So meaning we're going to be adding 10 kwacha throughout. So here we're going to have 110, 120, 100 and what? 30, because we are adding a constant. It's like an arithmetic progression of 10, 10, 10 throughout. But for compound interest, we're starting with 100 kwacha. So 10% of 100 kwacha in month 1, we're going to have what? The same amount, 110. Because 10% of 100 kwacha is 10. Now 10% of 110 is 11. So we're going to add 11 to 110. So month 2 will be 121. Then now we're going to do 10% of this amount here is 12.1. 12.1. So month 3, we're going to have 133.1. It goes on and on. So that's the difference, because the interest is based on the original. If it's simple interest, the interest is based on the previous figure if it's compound interest. Is that clear?
Yes, it is. Thank you.
All right, so this is what we call compound interest. This is when the interest is earned on interest invested over time, more than one period. Okay. So we got to what is called future value. This is the amount that we expect in the future. This is the amount of an investment worth in future. It's invested at a rate over a given period. That is what we call our future value, the amount we expect. So if we invest 100 kwacha, after 3 years, we're expecting 130. 100 kwacha is our present value. The 130 is the future value. The present value interest factors, we use tables. These are simply rates. We also have the present value interest factors. There are also rates that we're going to look at. But the present value is the current value that we have. It's like the principal. All right. So I will take you through simple computations of present value and future value using the formulas that will be given. Now, this is an interesting course because these formulas are also on the tables. So we have what we call simple interest, which is equal to PTR. The P is a principal, the T is a time in years, and the R is the interest rate. Okay, we have the future value, which is given by the present value that we have now. Then we have 1 plus R, interest rate, if it's compounded annually. What is to compound? To compound is to add what? Interest, or to earn interest. So compounding, if it's more than once, it affects 2 key things. Number 1, our interest rate will always be divided by the number of compoundings, or time will be multiplied by the number of compoundings. So to compound annually means you are earning interest how many times? Annually is how many times? Once a year. So I'll call this annually A. How about semi-annually? How many times? Twice. You're earning interest twice. How about quarterly?
4 times.
4 times. How about monthly? How many times in a year?
That's 12 times.
12 times. How about weekly? 52 times. And daily? 300 and what? 65, unless otherwise mentioned. All right. So our compound interest, therefore, is the difference between the future value and the present value given a compound interest. That is our compound interest. The amount we get in future minus the amount we started with. So if we started with 1,000 kwacha and we ended with 1,300, our difference is called the compound interest. Now, this is a very easy topic. I'm going to give you simple examples. Find the simple interest given the following. Find the simple interest if we're given number 1, our principal. If we started with 1,000 kwacha, and our interest rate is 8%, and our time is 5 years. So we need to find the simple interest and we need to find the compound interest. Okay, using simple interest, we say simple interest is what? P times T times R. So it's PTR. So our principal is 1,000. Our interest rate is 0.08. And our time is 5 years. So what are we getting? What are we getting? $400. That is the interest we're going to earn after 5 years. Okay, our compound interest is simply the future value, the money we're getting after 5 years, minus the money that we have now, the present value. So we know that the future value is given by what? Present value one plus R to the power time. So how much was our present value? 1,000. Plus what is our rate? 8%, so 0.08. And what is our time? Our time is 5 years. So what are we getting as our future value? Please calculate.
$1,469, I think.
1,469. Okay. So what becomes the compound interest? The difference. So 469 is our simple interest, our compound interest. All right. The difference. So which one is higher, simple interest or compound interest? The compound interest. All right, together. Okay. Now, there are certain times when the examiner would want you to compound the compound interest. So find the future value if our present value is 1,000, our interest rate is 15%, and our time is 4 years. So they'll ask you compound the future value, part A if it's compounded annually, part B if it's compounded semi-annually, and part C if it's compounded quarterly. Now, I said two important things. Number one, this compounding affects the interest rate and affects the time because of the concept I mentioned, that interest rates will always be divided by what? The number of compoundings. Okay, and the time will always be multiplied by the number of compoundings. So what is the formula for future value? If you remember, future value is equal to what? For an annual formula, present value 1 plus r to the power what? To the power time. So what is our present value? 1000. Okay, 1. What is our interest rate? 15%, so 0.05, 0.15 to the power time, 4 years. What are we getting? Since R is 0.15, so 1 plus 0.15 is 1.15. Okay. What are we getting as our answer? So one thing you need to understand is that the more you compound, the higher the figure. Are you there?
That's 1,749 on annually.
Okay. 1,749. 749. Point what?
0.006.
006, so 001. This is money, so even the decimals are important.
Okay.
All right. Then here it's compounded semi-annually. Semi means what? Semi means what? 2. All right. So our interest rate will be divided by 2. So our R is 15%, so 0.15 divided by 2. And our time is 2 times the years that we have, which is 4. So what are we going to have? 1,000. And this is 1 point what? 1.075 to the power what? 8. What are we getting here? Remember, the more you compound, the higher the figure. The more you compound, the higher the figure.
$1,783.47.
1,783.47. Good. Try quarterly on your own. So quarterly, what are we going to put here? So whenever it's compounded more than annually, this is a formula you use. Okay, so what are we going to put here? Future value is equal to 1,000 Then 1 plus, where there's error, we're going to put what? 0.15. Then we're going to divide the 0.15 by what? Since it's quarterly, what are we dividing 0.15 by? Yes, Betha? Quarterly stands for what? 4 times, yes. Then the 4 will come here times the number of years. How many years is it?
4 years.
4 years, good. So 4. So this comes here. So what do we get here when we divide? If you start from dividing this, 0.04 into 0.15, what are we getting?
Going to give us 1 plus 0.0375.
Okay. To the power what?
To the power 16.
Good. The one becomes the final answer.
Just a minute. The final answer is going to be 1,800. 1802. 0.23. 227.
So 23. Okay. So you've observed that the more you compound, the higher the what? The future value. All right. The more you compound, the higher the future value. All right. Now, since we've gotten the bigger formula, sometimes they'll ask you to find the opposite. For instance, if the future value has been given as 5,000 and they've given you an interest rate of 5% and a time of 2 years, compounded annually, they ask you to, so this is our time, they ask you to find the present value. So you use the same formula. Future value is equal to what? For the annual formula, future value is equal to present value 1 plus R to the power time. So our future value is 5,000. So you put 5,000 here. So in this case, you're just playing around with subject of the formula. Our present value, we don't know. Put PV here. 1 plus our R is what? 5%. In decimal, all numbers below 10 have a 0 in between. So 0.05. Please don't make the decimal mistakes. If it's 50%, it's 0.5 to the power time of 5. The time is 2 years. So 2 years there. So here we have 5,000 is equal to the present value, which we don't know. Then here we're going to have 1.05. What is 1.05 to the power 2? What is 1.05 to the power 2? So we divide both sides by 1.05 to the power 2. So that will only remain with the present value. So and this cancels, and this cancels, we remain with the present value. So 5,000 over 1.05 to the power 2. What do we get? So the present value is and should always be smaller than the future value. Present value is and should always be smaller than the future value. So what are we getting? 5,000 divided by 1.05 to the power 2.
$5,000 divided by 1.1025. It's going to be 4,535.15.
Good, 0.15. So this will be a present value. This will be our present value. Okay. Again, the present value, they ask you find the present value for a future amount of 10,000. So the future amount will be 10,000. Whose interest rate is 8% and time is 5 years, compounded semi-annually. Okay, now if you are compounding more than once, what formula are we going to use? Can you try? What's the formula? Future value is equal to what? Present value 1 plus R over what? The number of compoundings, M. Then here we have M multiplied by what? The time. All right. So our future value is 10,000. So here we're going to put 10,000. Our present value is what we're looking for. So we're going to put PV. We're looking for the money now. So 1 plus R, our R is 8%, so 0.08. Divided by the number of compoundings. Semi-annually means how many? 2 times. And here put a 2 here, times the time. What is our time? 5 years. All right, so here we're going to put 10,000. Since we want to calculate the value of the present value, so present value here, then here, this in there is 0.04. So here we're going to have 1.04 to the power what? 10. So now we need to calculate value now, which is called the present value. So 1.04 to the power 10, then here 1.04 to the power 10. So we cancel here and we cancel there. So what is 10,000 divided by 1.04 to the power 10? What are we getting? 6, 7, 5, 5, point what? 64. This is how we find the present value. So remember, we started with the future value, calculating the future value, now calculating the present value. Now let's go to calculating the rate, then finally the time. Then we're done with the basic calculations. Then we go to annuities. Sometimes you'll be asked, what rate can double 1,000 kwacha. So if 1,000 kwacha is our present value, to double 1,000 kwacha, it will be what? 2,000. So 2,000 will be our future value. What rate would double 1,000 kwacha? Compounded annually in 3 years. So our time is what? 3 years. So if it's compounded annually, it's a straightforward formula. You just put present value is equal to future value is equal to present value 1 plus r to the power time. What are we given here? The future value, which is 2,000. What else are we given here? The present value, which is 1,000. Are we given the rate? No, we're not given the rate. So we put plus r. What is our time? What is the time? 3. So we divide 1,000 here. Now it's beginning to get tougher. We divide 1,000 here. So this 1,000 leaves a 2 on the other side. So here we're going to have 2 is equal to 1 plus r to the power 3. Now this is where we just using some mathematics. If there's no number here, we're going to put an invisible 1 here. So we're interested in the r. The only way we're going to remove the brackets is by multiplying this power by the reciprocal. The reciprocal is simply the opposite. We're going to multiply this one by 1 over 3. Even here times 1 over 3. So that this and this cancels. So here we're simply going to have 1 plus r. And here we're going to have 2 to the power 1 over 3. So what is 2 to the power 1 over 3? It will be 1.26. So to remain with this r, this one will go and subtract this side. So r will be what? 1.26 minus 1, which is 0.26. In percentage, this is 26%. I'll go through this. What interest rate will double 1,000 kwacha to 2,000 in 3 years? So we know that for the annual compounding, future value is equal to present value 1 plus r to the power time. Okay, so our future value is 2,000, our present value is 1,000. 1 plus r to the power t, our time is 3. So we first divide 1,000 on both sides. So we're going to remain with 2 this side, and we're going to remain with 1 plus r. We cannot touch this r because it's protected by this exponent of 3. So if there's 3 there, we're going to multiply by 1 over 3. There's 4 there, I would have multiplied by 1 over 4. If there's 5 there, we multiply by 1 over 5 to just get rid of this. What you do on the left side, you do on the right side. So 2 to the power 1 over 3 is 1.26. So meaning here we're going to remain with 1 plus r because the brackets are out. To remain with r, this one will go and subtract from this side. So we're going to have 1.26 minus 1, which is 0.26, which ultimately is 26%. So our r is 26%. So now we go to time. how much time is required for 1,000 kwacha, the present value of 1,000 kwacha, to triple. To triple is to multiply by 3. So if this 1,000 kwacha is tripling, meaning our future value will be what? 3,000 kwacha. How long? Whenever you hear how long, we're discussing time. How long will 1,000 kwacha triple at a rate of 10% if compounded annually? How long will 1,000 kwacha triple to 3,000 if it's compounded annually? So we know future value is equal to the present value 1 plus R to the power time. So here the future value is what? 3,000. The present value 1,000. The interest rate is 10%. So here you're going to have 1.10. The time is what we don't know. So we divide both sides by 1,000. Even here 1,000. Now this is the toughest of them because of finding the t will require a special logarithmic function. So here we have 1.10 the power t. In any mathematical problem, the only way to find this t is by introducing logs on both sides. So here you're going to have log 3 is equal to log 1.10 to the power t. It is only a log that will cause this t to fall down in front of this. So meaning we're going to have log 3 is equal to t times log 1.10. Now we can compute for what? For t by introducing or dividing log 1.10 on both sides. So check on your calculator where log is and divide log 3 over log 1.10. What is log 3 divided by log 1.10? Check on a calculator. There is a log function there. Depending on the calculator you're using, you need to know your calculator. Log 3 divided by log 1.10. What are you getting?
Log 3 divided by log 1.10. 11.526, somewhere there.
Okay.
Do I need to shift or anything when I want to use the log?
No, that's direct. Log 3 divided by log 1.10. 11.53. Okay, good. So it will take 11.53 years. Great. So let me take you to now a few questions before we go to the exam type questions, so that you could understand how the questions actually could come. All right. So you'll be asked, number 1, invest $100 at a rate of 10% for a period of 2 years using simple interest and compound interest. I think we did this already. Simple interest, you'll be getting 10, 10, 10 throughout. So at the end of 2 years, we're going to get $120. 20. This is for simple interest. For future value, present value 1 plus r to the power t. So 100, 1.1 to the power 2, you get 121. So when we go to question number 2, what is the present value of 300 received 2 years from now, discounted at 10%? What is the present value received 2 years from now, discounted at 10%? So we know that future value is equal to present value 1 plus r. So the questions will sound a little bit strange, but very straightforward from what we've just discussed. So what is the present value of 3,000? So 3,000 must be a future value. So here you put 300. Present value, we don't know. So you put PV. What is our interest rate? 10%. So 1.10. For how many years? 2 years. So 2 years. So to get the present value, you divide 300 divided by 1.10 to the power 2. So you're going to get 247. This is how we calculate using this formula. Of course, sometimes they will give you a straightforward formula for present value, but I'm avoiding you to memorizing many of the formulas. But this is a formula for present value, simply future value over 1 plus r to the power time. I'll discuss more of this later on as I'll teach you how to read the tables. What is the future value at the end of the 5th year of the following stream of cash flows received at the end of each of the 5 years at 15%? So year 1, you have 300. So at year 1 here, there's 300. It usually starts from 0. At year 2, we have 200. At year 3, we have 150. At year 4, we have 100. And at year 5, we have 200. So this stream of cash flow will not earn any interest because it is just static. But this 100 kwacha will earn interest, but the period of time will be 1 year to the 5th year. So future value for this one will be present value, which is 100 itself, 1 plus r. Our r is 15%, so we're going to have 1.15 to the power time. So the time between the 100 and the 200 will be 1. So here we're going to put 1 year. The same here, we'll put 150 here, 1.15, but this is 1, 2. It will go to the 2nd year. Time will be 2. The same 200, it has how many years to year 5? 1, 2, 3. So on the time we put 3. This 300, 1, 2, 3, 4. So here we're going to put 4. Now this is what will take us to a new topic, which is called annuities. So this is what we're going to have in our next session, where we'll be discussing what are called annuities. But for now, I will give you some simple homework to do before we start our next session on annuities. So I'll send you the homework on the group, or you can copy this down. I'll find the missing figures, find the simple interest, find the simple interest given our principal is 1,000. Our time is 6 years, and our simple interest rate is 6%. You need to find the simple interest here, the way we did it. Part B, Find also the compound interest with the same figure that have been given. Then question number 2, find the future value. Given that our present value is 1,000, find the future value given our present value is 1,000. Our time is 10 years, and our interest is 7.5%. Compounded A, quarterly, and B, monthly. Then C, find what is called the effective annual rate. Find the effective annual rate. Then finally, question number 3, find the time. If our present value is 1 quarter, our future value is 5 quarter, and our rate is 2%. Just these 3 questions to cut out what we have done. You can get a screenshot. Otherwise, this is what I had for the first segment. So we'll go to another part, which will be called annuities. So I'll send you the notes of what we've discussed just now. Unless there are any questions this far, please ask.